A very good morning, friends. Today we are going to discuss an important topic international tax and the transfer pricing aspect of deemed dividend under Section 2, Class 22, Class E. Deemed dividend under the Section 2, Class 22, Class E of the Income Tax Act 1961 is a special section that provides for taxation on loan transactions, deeming it to be the income as dividend if the certain conditions are satisfied. However, if such a loan is to be taken in the hands of non resident, international tax and the transfer pricing provisions shall come into play. The article analyzes the aspects from an international tax and the transfer pricing perspective and provides possible view for various issues under consideration. Background: the Income Tax Act 1961 provides for charging of tax on the income of the taxpayers. Section 2, Class 22 24 defines income which includes dividend in its ambit. Dividend is defined in the Section 2, Class 22 of the Act, which also includes income that shall be deemed as a dividend. One of the categories covered under the Section 2, Class 22 is deemed dividend on account of loan to shareholders. Class E of the Section 2, Class 22 provides that a dividend includes any payment by company not being a company in which the public are substantially interested of any sum by way of advance or loan to the shareholder, being a person who is beneficial owner of the shares, not being the shares entitled to a fixed rate of dividend, whether with or without a right to participate in the profits, holding not less than 10% of voting power, or to any concern in which such shareholder is a member or the partner and in which he has a substantial interest. Hereafter in this class referred to as said concern or any payment by any such company on behalf or for individual benefit of any such shareholders to the extent to which the company in either case possesses accumulated profit. Analysis: the above deeming fiction has certain key elements for application. The payer of the loan should be a company in which public is not substantially interested. It should be a loan or an advance granted by the payer company to the receiver company. The taxation shall be to the extent of accumulated profit of the payer entity. Further, a key element under the consideration for deemed dividend taxability is the identification of the taxable entity for the loan granted, that is, either the borrowing entity or the shareholders under the Section 2, Class 22, Class C. Based on the cursory pursual of the aforesaid section and for the ease of understanding, it can be broadly divided into two categories: loan or advance granted to the shareholders. The company A borrower owns more than 10%, company B lender grants loans or advances. Scenario B: loan or advances granted to any concern in which such shareholder is a member or the partner and has a substantial interest. Here, if you see, there is no direct relationship, but indirectly, the company A shareholders is holding shares of more than 20%, in company C and the company B is giving the loan to company C. So this is an indirect arrangement. From a bare reading of the above section, it can be noted that the above section applies if both the conditions are satisfied. Loan is given to the concerned borrower company in which shareholders of the lender company is also the member. Such shareholders of the lender company hold substantial interest, namely 20% or more voting power in the borrower company. If the above conditions are fulfilled, the loan granted to the extent of accumulated profit of the lender company is considered deemed dividend liable to taxation. Taxpayers for deemed dividend under Section 2, Class 22, Class E. While the scenario A is quite clear, that is, the taxability should arise in the hands of the shareholders, who is also a borrower of loan. A pertinent question to evaluate in the scenario B as provided above refers to the diagram is that in whose hands shall such deemed dividend be taxable, that is A company, borrower company, C company, or B shareholders company. View 1. The CBDIT circular number 495 dated 22 September 1987 supports the taxation in the hands of the borrower concerned, namely Company C. View 2. The special bench of Bombay Tribunal in the case of Banumik Colors Private Limited held that in the absence of induction in the Section 2, Class 22, subsection E of the Act, to the extent the legal fiction to a case of loan or advance the non-shareholders. Loan or advance cannot be taxed as a deemed dividend in the hands of such non-shareholders. The decision of the special bench has been affirmed by the Bombay High Court in the case of Universal Medicare Private Limited and Delhi High Court in the case of Ankitech Private Limited. The Supreme Court in Madur Housing and Development Company provides a view that on this controversy and held that a deemed dividend is not taxable on the hands of the loan recipients concerned if such concern is not a shareholder of the lender company. It is liable taxable in the hands of the shareholders having substantial interest in both the entities. Recently, the Ahmedabad Tribunal, in the case of Aryavat Infrastructures Private Limited, held that deemed dividend under the Section 2, Class 22, Class E of the Act is taxable only in the hands of the shareholders and not the recipient of the loan or advances. Thus, view 2 is better view providing taxability in the hands of common shareholders. However, if the taxpayers is desirous of having taxability in the hands of the borrower concerned, it can lead to the on rely on the circular. The tax treaty interaction for non-resident shareholders in the case of deemed dividend under Section 2, Class 22, Subclass E. OECD model tax computation provides for the following definition of dividend. Dividend in two parts for ease of analysis. The term dividend, as used in the article, means income from shares. Josian's shares or Josian's share rights, mining shares, founders' shares, or other rights, not being debt claims participating in the profit as well. Part 1, Income from others corporate rights, which is subjected to same taxation treatment as income from shares by laws of state of which the company making the distribution is a resident. Part 2, Section 2, Class 22, Class C uses the expression by way of advance or loan. It pretends to examine the meaning and the scope of the term loan and advances. Loan, the Black Law Dictionary defines the term loan as an act of lending a grant of something for temporary use, a sum of money lent at interest. Advance, in same dictionary, the term advance has been defined as a payment made in anticipation of contingent or fixed future liability or obligation. Based on the above definition, it can be noted that the participation in the profit is precondition to the term it as dividend under the tax treaty and excludes debt claim, namely loan or advances. Thus, it is not covered in the first part of the definition. There are two possible views for the second part, which provides that other income which is subjected to the same taxation treatment as income from shares by way of state which the company making the distribution is a resident. View 1. It can be noted that the income is not subject defined in the tax treaty for which the reference is made for the Section 2 Class 24, which defines as income to include Section 2 Class 22 Class E. Income, namely the deemed income dividend on account of loan. Thus, it applies us to the article dividend in tax treaty. View 2. Though income is defined in the section 2 class 24, it is to be noted that the term used in the definition is income from shares and deemed dividend under the section 2 class 22 subclass E is per se not an income from shares. Further, it qualifies us as income only if the certain percentage of the shares are held and loan is given. This means it is not income from shares, but income because of holding certain percentage of shares in both the entities. The language of tax treaty does not distinguish between the classification of income holding certain percentage of shares or not. This additional layer of condition is not envisaged in the tax treaty. Venina conviction on the law of treaties established in Article 31 of the General Rule of Interpretation. A treaty shall be interpreted in the good faith in accordance with ordinary law, meaning to be given to the term of treaty in their context in the light of its object and purpose. In the manner of treaty interpretation, good faith demands compliances of following requirements. If the treaty is clear, the meaning should not change under the pretext of representing the spirit. The used term in the treaty must be assigned to their ordinary natural meaning and they should be interpreted taking into account the object and the purpose of the treaty. To a term, it will be assigned a special meaning if it is established that it was the intention of the parties. Thus, it can be contended that it cannot be income from shares as such. Rather, loan is classified income as per the local law of one of contracting countries on account of holding shares beyond a certain specified percentage which is not enraged under the tax treaty. Considering the above, it can also be argued that the class last sentence, which states that income from shares by laws of the country of which the company making the distribution is resident, sufficiently clarifies us that the amount should not be regarded as a dividend. In analysis of the provisions of the dividend, it is to be noted that the loan is a payment and not distribution. Language of the Section 2, Class 22, Class, Subclass A, B, C, D of the definition of the dividend in Indian income tax law categorically provides for the term any distribution as against the section 2 class 22 class E providing the term any payment. Under Indian jurisprudence, both the term, namely distribution and payment, have been distinguished as apparent from the observation in the case discussed below. CIT versus Jamna Das Srinivasan's Private Limited versus PV John. The expression distribution and the payment connotes different meaning. Distribution is division amongst several persons and connotes an idea of apportionment among more than one person. In the case of distribution, the resident would be more than more than one, while in the case of payment, the recipients may be a single person. Punjab Distilling Industries Limited. The dictionary meaning of the expression distribution is to give each a share, to give to several person. The only difference between the expression paid and the expression distribution is that the latter necessarily involves idea of division between the several persons, which is same as the payment to the several person. Distribution is accumulation of process. Thus, it can be concluded that such a loan transaction does not get classified as a dividend under the tax treaty. Consequently, it falls under the article other income if it is not effectively connected with the PE and the taxed accordingly. Transfer pricing aspects. To understand the transfer pricing aspects, consider the scenario B wherein a loan is granted to a related entity having a common shareholders. The borrower entity is outside India and the lender is an Indian entity. Based on the same, below are issues for consideration. A. Reporting it as a dividend versus loan. Which entity's name is to be reported? Shareholders as per the view to or concern per se which has borrowed the loan. Analysis of the reporting requirement. The transfer pricing provides for reporting international transaction in Form C3 CEB, namely the transfer pricing audit report as per the section 293E of the Act. International transactions as defined in the section 92B of the Act includes capital financing including any type of long-term or the short-term borrowing, lending or guarantee, purchase or sale of marketable securities or any type of advance payment or deferred payment or receivable or any other debt arising during the course of business. Thus, a loan to associated enterprises is an international transaction that requires reporting in the Form 3 CEB. Transfer pricing is a special provision as a part of Income Tax Act 1961, requiring computation of income from international transaction with associated enterprises, keeping the arm's length price in the mind. It is the special provision for the avoidance of tax. However, the Section 2, Class 22, Class E of the Act deems it to be dividend as against it loan transaction. The word deemed is not defined in the Act. However, the special generally a deeming provision assumes us that it is something else as against the reality. For example, loan is presumed to be dividend. The basic purpose of deeming provision is to allow the consequences of dividend income to apply, whereas the reality is that it is a debt and not a dividend. Thus, a view can be taken that deeming friction used for the avoidance of the aspects under the law cannot be extended further to other provisions of the law. This is supported by the Honorable Supreme Court in the case of Bengal Immunity Company Limited versus the state of Bihar, wherein the Chief Justice held that the legal frictions are created only for some definite purpose and legal friction is to be limited to the purpose for which it was created and should not be extended beyond that legitimate field. In CIT versus Mother India Refrigeration Industries Private Limited, it was provided that the legal fiction was created only for some definite purpose, and this must be limited to that purpose and should not be extended beyond that legitimate field. Such being the aspects for which the legal fiction is created, it is difficult to extend the same beyond its legitimate field and it will have to be confined to that purpose. Honorable Supreme Court in the case of CIT versus CP Satyan Mudare provided that the Section 2, Class 6A, Class E gives an artificial definition of dividend. It does not take the dividend actually declared or received. Dividend taken note of by that provision is deemed dividend and not a real dividend. The loan granted to the shareholders has to be returned to the company. It does not becomes the income of the shareholders. For the certain purpose, the legislature has deemed such a loan as a dividend. Hence, Section 2, Class 6A, Class E must necessarily receive a strict construction. Based on the above, it can be said that deeming fiction is specifically created to cater to the special tax avoidance measures under the law and the provisions. The same shall not extend beyond its legitimate field. Thus, the transaction as in the books, namely loan to a concern, may be reported. Secondary adjustment on deemed dividend. A similar view issue also came up during the introduction of the provisions of the secondary adjustment under the section 92 CE class 2 of the act. If the amount of the secondary adjustment is not repatriated to India within the stipulated time limit, it will be treated as a deemed loan made to AE for Indian taxpayers. Base subsection 2 of the section 92E C is reproduced below, where a resident of primary adjustment to transfer the price, there is an increase in the total income or reduction in the loss, as the case may be, of the assessee. The assessee excess money or part thereof, as the case may be, which is available with its associates enterprises, if not repatriated to India, it within the time as may be prescribed shall be deemed to be an advance made by the assessee to which the associated enterprises and interest on such advance shall be computed in such a manner as may be prescribed. View 1. Reading the provision of the Section 92 CE with Section 2 Class 22 Class E of the Act, together there arises a risk that deemed loan made by the taxpayers to AE could be treated as a deemed dividend. View 2, based on the analysis provided above in the para 5.1, deeming fictions are created only for some definite purpose for which the Section 92 Class E C was to charge the notional interest income in the absence of repatriation of the fund to India by AE. Thus, it must be limited to that purpose and should not be extended beyond that legitimate field. However, for this view, risk of litigation cannot be ignored as this might not be a deemed fiction as per se but presumption that is taken by the legislature for the said section. Honorable Supreme Court in the case of Bulwarka Steel Industries Limited and others versus the Union of India has discussed in great depth what a presumption is and what is the legal fiction. To put it simple, fiction assumes something that is known to be false. A presumption, whether conclusive or rebuttable, assumes something that may possibly be true. This means there is no possibility of fiction being reputed approved by evidence, but presumption may be reputed approved by evidence. In section 92 CE, it is well possible to substantiate that there could be an excess amount of money involved that does not comply with the arm's length principle. This money is paid outside of India, which is not reported and later takes the character and future of interest free loan. Conclusion: deemed dividend is a special tax and has always been an issue of litigation on the multiple grounds and aspects. With the foreign investments opportunities increasing in India in multiple sectors and India's GDP growing at highest rate in the world has attracted attention across the globe. With the recent announcement to make India the third largest economy in the coming 5 years, and several companies looking at India as a furnishing supply chain hub, it is anticipated that a lot of potential foreign investors will be investing in India. Thus, the aspect of international tax and the transfer pricing shall be shall play a crucial role in the future. Nevertheless, it is noteworthy that government continues to address the open issue and provide certainty of taxation which shall further boost the rate of investment to realize the dreams of India becoming one of the strongest and the largest economy of the world. Thank you very much. Have a great day.